Here with the takeaway on the Berkshire Hathaway annual meeting is Matt Kafina, editor of Morningstar Stock Investor. Good to see you here in Omaha.
Thanks for having me.
So what have you learned so far today from Warren Buffett and Charlie Munger? What should shareholders be focusing on with these comments?
You know, there's not always a lot of new information at these meetings. Warren Buffett and Charlie Munger pretty much say the same thing every year, and really that's a good thing. It shows their consistency. You know, they have a very disciplined philosophy. They've been following it for 50 years now, and it's consistently worked for them. So I wouldn't say there's a lot of new information from year to year. One thing that there has been discussed a lot so far in the meeting is 3G and their strategy, which Berkshire's partnered with 3G now on a few deals, Heinz and Kraft. And their strategy is really to come in and just lay off a lot of people, really trim down the cost structure. And a lot of shareholders seem to be concerned that this is incongruous with Berkshire's usual operating philosophy, which is they buy these companies and then pretty much leave them alone. But Warren Buffett really tried to emphasize that Berkshire doesn't believe in hiring more people or employing more people than you need to run a business. It's just not the way that capitalism works. It's not an efficient system. So, he wishes that all Berkshire holdings were operated like 3G, and he's willing to tolerate maybe somewhat less efficient operations in some of the subsidiaries, but he's totally on board with 3G's operating philosophy.
There was also a few questions on Clayton Homes and some concerns about predatory lending. Do you think he answered those concerns adequately?
Yeah, he definitely came prepared to talk about the Clayton Homes issues and some articles that have been out there. He had several slides on it, which is unusual. And I thought that he did a very good job of refuting the arguments. And basically they said there's going to be some foreclosures. Their foreclosure rate is about 3% a year. And that just means that they're operating the business properly. If they had no foreclosures, it would mean that they weren't lending money to people that deserve it. Not everyone, especially we're dealing with lower income consumers, not everyone's going to be able to afford payments down the road. Maybe they lose a job or have some kind of family emergency. So it's healthy for the business to have some level of foreclosures. And again, if they didn't experience some foreclosures, it would mean the credit was too tight, that they weren't lending to people that deserved it.
So Berkshire is in some of your model portfolios. Did you hear anything that would make one want to add to those positions or sell?
So we've owned Berkshire in one of our model portfolios, the Tortoise portfolio, for going on 14 years now, since our inception in 2001. It's actually our largest position in that portfolio. And I would say no, it's a very consistent story all the time. Berkshire's not going to grow at the rate that it has historically. It's just not possible given such a large company that it is. If they grew at the historical rate of 20% a year, they would end up owning the entire U.S. economy in the next 50 years. But that said, I think Berkshire is reasonably valued. It's trading at a discount to our estimate of its intrinsic value. We come about that by doing a sum of the parts analysis on the railroad, the utilities, all the various operating businesses, plus the insurance segment. So we think it's reasonably valued, and I think over the long run they can continue to compound their intrinsic value at maybe 8 to 10% a year. So you're not going to necessarily get rich owning Berkshire going forward, but I think it offers a lot of downside protection in a bear market and pretty stable, steady kind of long-run total returns in that 8 to 10% range.
Have you factored in what the impact on Berkshire will be when interest rates start to rise?
So there was another question about that, and I think Buffett made the point that for the stock market as a whole, current valuations are reasonable if interest rates stay where they are, or the stocks are even cheap if interest rates stay where they are. But if interest rates go back to a more normal level, say in the 3 to 5% range on the 10-year, the stocks on the whole are probably overvalued or materially overvalued, definitely trading at a premium to historical valuations, and the big difference being that interest rates are much lower now than they had been historically. For Berkshire itself, I think it's like any other company. The future cash flows are going to be discounted more heavily in a higher interest rate environment. But if anything, the company is probably more insulated than most, given the diversity of its businesses, its ability to continually reinvest capital at higher and higher rates of return. So I'd say Berkshire is very well positioned for really whatever environment comes. But interest rates could potentially be a headwind for all stocks, and investors need to be aware of that.
Matt Kafina, great to talk to you. Thanks so much.
Thanks again.